Tyler, it is almost the end of 2024, and the stock market is, I don't want to say up because the S&P and NASDAQ are still a little down from the high. The Dow just made a new record high. But a lot of our favorite stocks are still kind of small. You mentioned a couple of weeks ago that you thought this was going to be the year of the small cap, if I'm not mistaken. Or at least not the big tech companies are going to outperform again. Um, you know, everyone has different definitions of what is a small cap, what is a mid cap. You ask 10 different investors, you'll get 10 different answers for that. But there's an argument to be made that not an argument, it's actually a fact that the returns of the past few years have mainly been generated by the 7 largest companies in the market. So we're going to look at some that you might not have heard of, or that might just be a little smaller, that we think could be monster winners over time. Before we get into it, please take a minute and check out the link you see on your screen for a message from our sponsor, The Motley Fool. Get the top 10 stocks to buy right now, and it's a great way to support this work we're doing. So I'm going to go ahead and kick this one off, I think. I am going to talk about a company that I've mentioned before, but now that we've gotten, as Tyler puts it, a glimpse of lower rates, this one could be a bigger winner than we thought. So I'm talking about SoFi. It's one of my favorite stocks as we head into 2024. And there's a few things that really stand out to me as impressive about SoFi when it comes to their momentum. Number one, a lot of people don't realize this. SoFi's been around for a while. They've been in the private student lending business for years, even before they were a public company. They were one of the first private student lenders that really pioneered that field. But they just became a bank in 2022. It was mid-January 2022 they got their banking charter through an acquisition. So they weren't able to accept deposits directly until that time. Since then, as of the end of the third quarter of this year, they've grown to almost $16 billion in retail deposits. That's in less than 7 quarters. That's a pretty impressive growth rate. And I think that's going to continue. And that's a big thing, big part of the thesis, as I'll talk about in a second. There are 7 million SoFi members now, almost. It should hit about 7.7 at the end of the year, given its current growth trajectory. Their CEO says he's targeting 1 million or more new members per quarter next year. I think they're going to beat that. They have a strong history of outperforming their expectations. And the reason that is significant is that the more members they get, most of their members are getting financial services products, not loans, like checking accounts, brokerage accounts, things like that. This creates a low-cost marketing funnel for their loans, which acquisition cost has been a big drag on the company's results till this point. When they don't have a big deposit base, or before they were even a bank, they had to aggressively market for people to get loans on their platform. When they have millions and millions of people who have a banking relationship, it's a lot easier to cross-sell lending products, which is where they make the bulk of their money. So that's one thing. Financial services products I mentioned are what most people are getting. That's growing rapidly, 50% year over year. But the average SoFi member has just 1.3 products with them. The big banks, the average customer has 4 or 5 products with the bank on average. Think a savings account, a checking account, a CD, a loan, a credit card. So the average SoFi user has a lot more room to get cross-sold on a lot more products. And profitability is trending in the right direction and should continue to do so. They're expecting GAAP profitability in the fourth quarter, which they've reiterated several times. Analysts aren't really buying it, though. They predict, yes, they're going to be profitable, but not by much. The average consensus estimate is 6 cents per share next year in earnings. So I think that's a lowball estimate. But in this glimpse of lower rates that we've gotten recently, I think there are some big factors that people need to pay attention to. One is cost of capital. I mentioned that deposit base is skyrocketing. Right now, I have a SoFi account. It pays about, I think, 4.6% on my deposits. That will decline as soon as rates start to drop. SoFi has, been very reactionary with interest rate increases when it comes to staying competitive and raising yields. It'll work the other way in a falling rate environment, but the yields they're getting from their loans will stay the same. So that will be a big profit driver. And number 2, I mentioned SoFi started as a private student loan company. That business is not viable right now. Yes, they have a loan book and they're making money on it. But as far as getting new private student loans or new refinancing student loans, especially, that's not it's not a good value proposition for the consumer right now. I have no reason to refinance my student loans with a private lender because the rates that they're paying are they're no lower than what I'm getting from federal loans. About 2 years ago, SoFi was offering student loan refinancing with like 2.9% interest rates. If I have a federal loan at 6.8%, which is what one of mine's at, that's pretty tempting to look into, especially if I'm not going to qualify for public service loan forgiveness or anything like that. The student loan business is a big part of the business. It was, especially before COVID, and could be again as rates fall. So I think over time, SoFi could be a monster winner. I think it's still very small in the context of banks. I've talked about Ally Financial in a recent video. For reference, SoFi's deposit base is roughly 1/10 of what Ally's is. So a lot of room to grow. And Ally's not even a very big bank. So a lot of room to grow here. Tyler, I know you are probably going to talk about something in the energy sector. So what do you got?
I am, and I do want to continue the student loan conversation. We can maybe we can preview something else we'll talk about in the future, but I do want to talk about SLM Corp, which used to be Sally Mae, because there are some fascinating things going on there. But that's for another time, maybe a little sneak peek. The company I actually want to talk about for 2024 specifically is Noble Corporation. I'm going to go to a place that has burned Matt before in the oil and gas industry, and that's offshore rigs. So apologies to keep trying to force this down your throat. Noble Corporation is, like I said, it's an offshore drilling rig contractor, which basically means they own the rigs, and then the large companies, either a national oil company, integrated oil company, or independents that want to actually drill, they will rent these rigs for them from them for multiple years. Noble Corp has developed a pretty good reputation, I guess you could say, in the industry. They are the number one contractor for ExxonMobil, number one for Shell, and for Total Energies, which is the French integrated oil and gas company, as well as BP. So it has some deep industry connections. It has been one of kind of the contractor or rigs of choice for multiple reasons. Very new, high technology rigs that can do the most modern, most demanding drilling jobs today. And what is attractive to this to me in particular is, number one, it has an incredibly good looking balance sheet. It went through Chapter 11 bankruptcy during the big declines in 2020, but it came out, it recapitalized, it basically has almost as much cash on the books as it does total debt. So it in terms of balance sheet resiliency, it looks incredibly good. And the market for rigs right now looks incredibly attractive. Day rates have been ticking up at a relatively steady pace because oil prices are getting better, and these producers need to find a way to replace their existing production, and they're going more and more to offshore as of lately, particularly in places like Guyana for ExxonMobil, where they have a huge find. Offshore Brazil has been extremely popular, as well as offshore West Coast Africa, particularly like Angola and Namibia area. ExxonMobil, Shell, Total, those are kind of their big hubs of where they want to kind of grow production over the next couple of years. And what's particular about 2024 is a lot of the contracts that Noble had previously signed are set to roll over in 2024 specifically. And so they're going to get repriced at some of these current contract rates, which are much, much higher than what they have right now. So you have a business that has a good balance sheet, has good margins. I think its return on capital invested right now is like 11% at today's on their legacy contracts. And with this big contract rollover coming in 2024 and the potential for much, much higher rates, I think there's an opportunity here for a company that's going to look immensely profitable in 2024. And I think the market may be underestimating how lucrative that could be by the end as we head into 2025.
Once again, thank you so much for joining me. Be sure to click subscribe if you don't subscribe to my channel already. And as always, this video is sponsored by The Motley Fool. Be sure to visit www.fool.com/Frankel to receive the top 10 best stocks to buy now.